Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Once again, I want to welcome you to our channel, our YouTube channel here. I've decided to start a series because I've been looking at some of the screens that I routinely run with my FastGraph tool. And I've always talked about the fact that it's a market of stocks and not a stock market. And the reality of it is, if you look at the overall stock market as measured by either like the Russell 3000 or the Standard & Poor's 500, the markets are very, very extended right now. But as I've always pointed out, it's a market of stocks and not a stock market. So if you're willing to look, you can always find stocks that have attractive valuations, no matter how overvalued the market is. So let's go ahead and move to FastGraphs here, and let's look at the valuation of the market as a whole to start. As you can clearly see here, this is the S&P 500. For those of you who are new to the site, let me just make sure I clarify things. This orange line on the graph is a fair value of 15, PE ratio of 15. And that fair value 15 PE ratio is what I would call fair value. But I want you to notice the S&P 500 has had periods of growing earnings, periods of dropping earnings, followed by long periods of growing earnings, flattening earnings. This is COVID. This, of course, was the Great Recession. But generally, there's been growth, and it's averaged just under 8% a year, 7.83%. And that includes some forecasts for some good growth going forward. As you can see, 10% in 25 and 14% in 26. But now, another line that we normally put on the graph is what we call the normal PE. And this line, this is I like to call our fair value line. This line would be our market value line, meaning that this is a line that kind of references what the stock market has routinely valued a stock, or in this case, the S&P ETF 500 ETF. But if I put weekly closing stock prices on the graph now, you should see the prices follow in somewhere in between these two lines for reasonable valuation. So let's go ahead and put that on here. And you can see that's generally correct. There are periods where the price gets directly between those two lines, and that's a 15 PE and a 19 PE in this time frame that I have drawn here. The normal PE ratio has been 18.91. So that's anywhere you touch this blue line, or the price touched this blue line, you'd have a PE ratio of 18.9. Of course, anywhere it touched the orange line, you'd have a PE ratio of 15. So you can see the market is traded comfortably between that 15 to 19 PE ratio over the last couple of decades. But then we do see periods where it got below that. Coming out of the Great Recession, we had this nice 2 or 3 year period where you could have bought the S&P at a 15. I would consider this a great time to buy it. But this is also fair market value. You could have bought it at an 18 or 19 PE in 2015, 16, and probably all the way out here to 2020. But then coming out of COVID, we had this massive rally in the market, and the PE got almost 24 times earnings. And then we had this correction in the market, and now we got the market trading at a PE of 25. Well, even though we got good growth, I would call this extended valuations. But one of the things that FastGraphs offers, it offers a very powerful screening tool, and you can maintain screens and make screens and save those screens. And I've done that for you. What I'm going to do here in my next series of videos, I'm going to go through several of my screens, and I'm going to screen for value. I'm known as Mr. Valuation. Now, I'm going to start with one of the ones that's the easiest for people to recognize. I'm not going to necessarily do it in alphabetical order. I've got consumer staples for income and consumer staples for total return. So let's go ahead and go to the screen, consumer staples for income. Now, I got the consumer staples sector. That's what I screened for. I screened for primary tickers. I screened for dividend yield of 2% or better because this is consumer staples for income. So I want a minimum of a 2% dividend yield. I want to see what the PE ratio is, so I checkbox that. I want an earnings yield of 6% or higher. 6.5 to 7 is what I consider fair value. However, 6% would be close. And then I want stocks that have pretty consistent earnings. So I'm looking for an earnings persistency score of greater than 60%, meaning that the stocks are generally growing their earnings. And that's all. It's a very simple screen. Now, what I do then, after I created that screen, I go ahead and run query, and I ended up with 10 stocks on the list. And these are all recognizable names, I think, for most of you. Dollar General, Conagra, Smucker, the Jam People, Nomad Foods, you may or may not know. Target, of course, everybody knows. Campbell Soup, Molson, Coors, Beverage or beer company, Altria, the old Philip Morris, Kroger, and General Mills. Now, these are all stocks that have PE ratios that are under 15, with the exception of Target. It's just barely over it. But they're all stocks that have an earnings yield above 6%. Target is the lowest right now at 6.36%. Okay, so if I go through these very quickly, these would be research candidates. That doesn't mean that this screen would create a list of stocks you'd want to buy, but it's a list of stocks that would be worthy of your time to research to decide if you wanted to buy. And remember, we're buying for income. So if I look at Nomad Foods, and it's a British island company, and by the way, another advantage of fast graphs, you can always go to external links and go into the company's website. And if you don't know what the company is or what the company does, you can always go to their website and learn about their products. And you can see a lot of these products are recognizable. Bird's Eye, Igloo, Keto, Aunt Bessie's, Goodfellas. Some of these are real known in the U.S., some of them are not. But again, they sell their products all over the world. All right. So anyway, that's Nomad. Now, what I want you to notice by this graph is they're just apparently initiating a dividend in 2024 of 60 cents a share. That gives them a current yield at the current valuation of 3.41%. So I've got this listed as an income potential. It's over a 2%. Now, we don't have a long dividend record, but we've got an expectation of perhaps decent dividend growth. Looking at the forecasting graph, the company is expected to grow over 9%. And what I do with the forecasting calculator is you're able to run the numbers out to the logical conclusion. If Nomad PE expanded from its current level of 9 to a PE of 15, then that means this company would generate a 38, almost 39% annual rate of return over the next 2.25 years. Now, the growth would be about 95%, or you'd almost double your money. $10,000 would grow to $19,589. Plus, you'd have the opportunity to earn about $700 or almost $800 in dividends to turn your $10,000 into $20,834. Now, I also like to run all these stocks on two things. If I looked at the normal multiple of Nomad, and let's revisit that, you can see that the normal multiple for this stock has been below the 15 multiple, although it does trade at 15 quite often. So the 12.6 would be a more conservative number. So if I'm doing forecasting and I'm using the normal multiple, the 5-year normal multiple has been 12.92. So if the stock generated these levels of earnings that these analysts that are following the company expect, and if it traded at a PE of 12.92, I'd still stand to make 30% a year annualized. And I'd turn 10,000 into 17,675. Growth of 6,880, income of 794, the same dividend, for a market value plus dividend of 17,676, and that's a 30% annual rate of return. So this could be a very attractive stock, and you'll note that it could be good for either total return or income. Okay, now going through these others real quickly, Target is the one that had the lowest earnings yield of 6.36. You can see the price is just a tad above the 15 PE, but although normally this stock commands a slight premium of about a 17 PE, so if I went to forecasting here at a 15 PE, Target would still give me the potential to make double-digit returns over the next 2 years. If I looked at their normal PE, which has been about 17, it could get to where it's over 16% annualized rate of return. That would make Target a good buy. And again, I've got a 3% yield. And if I'm looking at this opportunity, I can get an opportunity to earn $710 on $10,000 in income alone. Now, going through the rest of these very quickly for you, so you're kind of getting the picture now. The next one I'd look at is Campbell Soup. This is not a fast-growing company, but is trading at fair value with a 3% dividend yield. And again, if I went to forecasting, this wouldn't give me a real high total return, although 9% is not bad. And by the way, this has a July fiscal year. So notice you've got almost 2 3/4 years here that we're going out to, earning a 9% rate of return. 8 or 9% is what we'd expect from this company. But again, it's Campbell Soup. It's a blue chip food company, if you will. The next would be Molson Coors. It's only expected to grow at 4%. Its normal PE ratio has been about 11, but even at that discounted PE ratio, if it went from a 9.8 PE ratio that it's currently trading at up to an 11.46 PE ratio and grew by, we'll call it 4% plus paid a 3% dividend, we'd tend to make 14.47%. If it would trade at a fair value of 15 PE, that rate of return could be 28.7. One of the keys here is having an absolute estimated rate of return in mind when you buy a stock. You don't just buy a stock on a hope and a prayer. And if I look at Molson, it's a pretty consistent grower. There are times when the market is priced at very high valuations. In recent years, it's been undervalued, but this would be a good time. The old adage, you buy low and sell high, to buy Molson. Altria has been trading at a low valuation for the last several years. You can see the stock at one time commanded a high valuation. It's about a 7.5% grower, but it pays an 8% dividend. And that's really one of the attractions. Remember, this is my consumer staples for income. And if I look at forecasting here, we're only expecting 4% growth. But using the normal multiple here of 10, we'd still stand to make over 13%. The majority of that coming from the dividend, I want you to notice. Okay, we'd only get $1,263 in capital gain potential, which is this number right here. So 10,000 would grow to 11,263. That would be a $1,263 profit, but you get $1,903 in dividends. So again, the majority of the rate of return off Altria would actually come from the dividend. Moving on to go through this, Kroger, it's another one, decent grower, trading at a very low valuation, looking at forecasting, low growth potential, but at a 15P, that would give us a 14% rate of return. At a normal multiple of 11, it would give us only about a 1% rate of return, but it would throw off 2.29% income. So this one might not be real exciting if you went on the conservative way, but if you'd use this drop down here and looked at the normal valuations, the current 11 valuation is relatively low. For a lot of the time frame, it's traded at 12 and 13 multiples, and that would be something like, if to look at it, it'd be up here, it'd be a 5 or 6% rate of return, but it is a triple B rated company and it's a blue chip. General Mills is very similar with a 16.78 PE. Normal, it could give you an 11% rate of return. In this case, if we looked at the 15 multiple, it would give you a 7% rate of return. When I'm evaluating these stocks, I look at how the market has typically valued it versus fair value. Now, for about certainly a third or half the time, it has traded somewhere around a 15 PE, but it's also traded at much higher valuations for about half the time. It wasn't too long ago, just May of 2023, it was overvalued. It came into fair value, rallied, it's back into fair value now. And again, the stock offers the opportunity to generate a 7% rate of return at a 15 multiple, but at a normal 17 multiple or 16.78, it could do 11%. And again, you can always look at this drop down and even apply higher multiples like a 17 multiple, and that would give you almost a 13% rate of return. And again, these are quality consumer staple companies. Now, I have these for income, but I want you to note that I also produced this list where what I did was I went, instead of going for income, I ran the screen for consumer staples for growth or for total return. Let me go back to my screens here. I went to my screens, go to my screens, so how to do it. And I looked at consumer staples total return. I just showed you the income portfolio. And again, I go through a similar screen, only in this case, when I looked at the actual dividend, I didn't really care what the dividend was. I didn't put any minimum yield, but I still got almost the same exact companies. The new one on the list would have been Empire, which is a Canadian company that has about a 2% dividend yield, and it's trading right at its normal valuation. And that's really the only difference. But my point is, I'm getting a very similar group of companies. I got Smuckers here, I got Nomad, I got Target, I got Campbell Soup, I got Kroger, General Mills, etc. So this would be in the consumer staples. These would be candidates that are attractively valued in today's overvalued market. And so I'm going to go through several other screens with some of the other sectors here in future videos coming up to show you that even though the stock market itself, if I'm looking at either the Russell 3000 or the S&P 500 looks extremely overvalued relative to historical norms, there's still stocks that you can buy in today's market. Anyway, this has been Chuck Carnevale, co-founder of Fastgrass. Thanks for watching. I hope you enjoyed the video. Going through these sectors and seeing what's available in different sectors, I think will be an interesting exercise. So tune in to future videos coming up. Thanks for watching. If you like this video, give me a like, subscribe to the channel, and take a look at subscribing to Fastgrass because it can certainly help you make wiser, more prudent, and hopefully more profitable long-term investments if you understand the business behind the stocks you're investing in. Thanks for watching.